Hi, everybody. This is Chris Kimble, founder of Kimble Charting Solutions, and welcome to another edition of your Daily 5. Today's September the 23rd. I've shared several times over our talks about us being welcome to the experiment. We're going to dig into that a little bit more. This is a picture from the movie Young Frankenstein. We're going to talk about yields breaking out, why are commodities falling, how to take advantage of rising rates. Do we actually even really need the Fed? What will give you a clue to the Fed's next move, what assets are suggesting that this week the June lows won't hold, and how to take advantage of the tech wreck. So one of the things that I've been sharing with our members, and even on this call for years, is welcome to the experiment. And I looked up the definition of an experiment, and you can see one of them is test a hypothesis. And so I think we're all unwilling participants in the largest financial experiment known to mankind. And here's one of the experiments that's taking place that might not be going so well. This is the 10-year yield. I know this is a chart that almost everybody on the planet knows that it's breaking above a 40-year resistance line. And so for the bond market, this is a real issue. And because it's an issue with the bond market, it could very well be an issue with tech, and then following in other things, even into the commodities market. So we just passed an inflationary bill. And, is this part of the reason for this type of a result? Because we're part of an experiment. Remember, an experiment, you just don't know the outcome. So in the last 6 months, yields are up 58%. DBC, the commodities ETF, is down almost 7%. Copper's down 22%, and the mother of all commodities, crude oil, is almost been cut into a third. It's lost over a quarter, percent of its value. So why are these crazy things, going on? And I think this is why, if you're involved in technical analysis, I think you ought to breathe a big sigh of relief. If you're using historical models, I imagine, like a 60-40 portfolio, this has been a nightmare of a year. And so that's why I want to high five you if you're using technical analysis, because in an experiment, you don't try to have these preconceived notions. And so as everybody's trying to fight the Fed, or, as this chart says, fight the rate trend or let the rate trend be your friend. Just billions are in and trillions are in bonds. They're losing value. This is one of the easier plays, everybody. We started highlighting this in March of 2020 with Howard Lindzen on Panic with Friends, that, hey, the largest bullish reversal in yields has taken place. Now we see this breakout. So folks, if you're not aware of it, this is TBF. And if you can see from the start of this year, it's almost went from 16 up to 21 bucks. So here's a way to not only, if cash has been king this year, but TBF has even been a super king from a performance wise. Busy chart, but I asked the question, do we really need the Fed? The blue line is the 2-year yield, and the orangish line is Fed funds. And you can see that the 2-year, for the most part, is just the leader, and the Fed funds are the follower. And so right now in the lower right, there's a spread of almost 76%. And what does that mean? Is that the current yield on the 2-year is 76% above Fed fund rates, and the largest gap was back here at 26%. So for the bond bulls, or if you own bonds, in the past, this has actually been good news when the spread was this large, that yields were actually closer to a high than a low. So one of the things I wanted to look at is, if the 2-year yield is important, and it is breaking above this falling resistance line that you can see in blue from the 1980s, I applied Fibonacci to the high in yields in 84 to the low in 2020, and the 23% retracement level was just pushed above this month. This is a monthly chart, so you see an attempt to be a monthly breakout at 1. And so if we're looking for any upper level resistance in 5-year yields, 2-year yields, it comes in about at 5.3%, where there was a double top. So there's still about 130 basis points in yield that could go up on the 2-year before it hits major long-term resistance. We've been hearing a lot about the 2-10-year spread, and that's what's in the black, and then the red's the S&P. I think, what you ought to pay attention to is, yes, pay attention to when the spread's high, but really pay more attention when the spread happens to roll over, which it's not yet. But you can see these red arrows. Here was the rollover in the spread in 2000. We know it's followed by a 50% decline. We see a rollover in 07. We see the S&P 50% decline. We see a rollover as far as COVID, when we see a 35% decline in a few weeks 2 years ago. And now we see the highest level in the 2 10-year spread in this entire chart going back 30 years. So a real sign would be, folks, is not that this is high, is actually if it starts turning down, that would even be more of a bearish sign. This was from our last take 5, and what I was trying to show is that the CRB was the furthest above its 80-week or 2-year moving average in its since essentially 1980 and 42 years. And at that time that it was very much elevated, it was hitting falling resistance. And so we've all heard of the magazine cover, where the magazine cover says this, and actually you got to do the polar opposite. Well, did this just happen from a government bill passing? They passed the inflation bill, and all of us know it wasn't just about inflation, but they labeled it that way due to society's concerns. But right up here, as they passed it, is when it was hitting resistance. So maybe they should have passed the inflation bill down here and then hope for some inflation up here. So one of the things, this is another chart that I'm going to update, is crude oil a few months ago in the invasion created its largest bearish reversal in history. And what's happened since? It's fallen sharply. What about gold? Here's the largest bearish reversal, or one of the largest bearish reversal in gold's history, and it double topped. And then you can see what's happened. This was all at the time of the Russian invasion, everybody. What did wheat do? It had its largest bearish reversal, almost a 50% flip in one week, or 1 month, excuse me, to create this. And then here's commodities. So if crude would happen to break down here, and gold is breaking down, and if wheat would happen to find no support, what do you think will happen with commodities here? So this is a double-edged, you know, when you think of the word fugly, you know, this is really ugly to see commodities falling, real estate falling, stocks and bonds falling, and interest rates and the cost of money going up. That's quite an ugly spread taking place. Junk bonds, what's their message? Folks, here's the June low. We're already below that at this current time, so wouldn't be a surprise if stocks didn't hold at the June low based upon the junk bond message. Real quickly, here's the Qs in the upper left. This is essentially a 1-year moving average. Look how the Qs, the NYSE, the Russell 2000, and the Wilshire 4500 all came up, kissed the underside of the moving average and the fib level, and then selling started again. And as we speak this morning, this was a live chart as of right after the opening on this Friday, the 23rd, the NYSE was attempting to break below the June lows. One of the things that has me concerned is that this is a chart that I came across recently about buying the dips. And you can see that there's been so much money moving into the market. And, you know, as I was sharing with someone earlier, is the market's down 20%, but we really don't see many outflows. And so this was a piece from Fidelity that was printed yesterday that you can see the enormous amount of inflows, but yet despite us being in a quote unquote a bear market, the outflows really aren't that great. So maybe the panic hasn't quite struck. Here's one that should be of concern to tech investors. This is QQEW, the equal weight tech. It's attempting to break below the rising support line that's 12 years old since 09. So is that bad news? It's bad news if it's long, but here's a play to make money with, which is PSQ. You see since the first of the year, PSQ has now made a series of rising bottoms, and also it's above its moving average. So there are ways, folks, to make this all to your advantage. And the last chart that I'm going to look at is, I don't have any idea why this takes place, folks, but this looks at turning points based upon the first day of spring around March 21st, the first day of fall around 9/21. And I don't know why, but particularly if you look from the bear market of 2000 to 03, many inflection points took place around these magical spring dates and fall dates. Same thing from in the financial crisis. Then there was just pretty much void of it until we started back in 2018. And then lo and behold, if I ask you, what was the high last year? It was the first day of winter, December the 24th. When did the low so far this year take place? The first day of summer. So this is a big test. What the bulls hope is that we actually have an inflection point bottom take place right in here on these seasonal dates. So thanks a lot for joining us today on your Daily 5. We do offer a 40% discount for any StockCharts member, and you can find this discount by going to kimblechartingsolutions.com/StockCharts. Thanks, everybody. Have a great weekend.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.